Okay, this is a lecture to figure out what we want to do and how we want to do it. The bottom line is everything in life is based on this. Value. Everybody wants value. Somebody wants value from you. You want value from them. Question is, what is the value? What does the other guy have? So everything is a chess game. Excuse me. It's cold. Everything is a chess game. You got to figure out what they have, what they want, and how to make it work. The bottom line to this value in terms of taxes is this right here. A JOB, dirty word, 3 letters, stands for jumping over bumps. The average person never gets beyond a JOB, okay? In the tax system, you're not going to get anywhere with a JOB. A JOB has 3 boxes. It has a gross income, and that's where the term comes from. It's usually pretty gross. Then what you have is a box called taxes. And then what's left over is called a net. Basic. You notice how the boxes get progressively smaller, right? There's an old saying with this. It says, there's an old bumper sticker that says, my take-home pay won't take me home anymore. This box of taxes just gets bigger and bigger and bigger to the point where nothing's left over. Over here, those in business have a different scenario. They'll never teach you this at the public school system, the government schools. Business is where everybody should be. Matter of fact, there's a scripture in Luke 19 that says that God says, get into a business. And so a business has a gross income, then they have a box, then they have their net, and then they pay their tax. Completely different system, isn't it? The haves and the have-nots. The haves have an extra box. The have-nots do not have that box. Here you pay tax on your gross income. Before you ever get it home, they take the money away from you, don't they? Federal, state, socialist insecurity, state disability income, especially here in California. Over here in business, you've got a box called expenses. Expenses, there are 250 to 300 areas of deductions that are allocated for a business person. They're not allocated for a job person. So the way you get your net lower is come up with all these expenses. Pretty basic, right? Now, they're not teaching you in the public school system, but nonetheless, the question I tell my clients, how quickly can you move from there to there? Now that is value. The average enrolled agent, the average CPA, attorney, they're not going to teach you how to win. Over here, these people have a potential for winning. These people will never win in the tax game by staying at a JOB. So you got to get people to move. Well, once you tell them that, and their enrolled agent, their accountant, their CPA has never told them this stuff before, they go, oh, no one ever told me this before. All of a sudden, your value to that client goes through the roof, doesn't it? Okay? Now, you're going to run into some people that already have a business. Does that make sense? And then all you have to do is explain to them this. That's why we have what we call our lexicon of business expenses. Okay, so the point is there's a whole list of things you can write off. And one of the other ones we're going to do, we're going to actually go through the list, okay? The list of what you can write off. So when you're in the marketplace, you need to make this kind of a example for the guys that have the JOB and the guys that have a business. The same lecture goes to both parties. If the guy already has a business, does he want to know about a job? Yeah, he does. And the reason he does, he goes, I never want to go back there again. You see what I'm saying? You've planted it very firmly in his mind that that's not the answer, to making wealth. Now, a lot of times when I'm in lectures, I ask the audience, I said, I want you to close your eyes for a second. Think of all the people you know that have lots and lots and lots of money. How many of them came from this sector here, JOB? Virtually none. Virtually none. Now, they could take their money from a JOB and invest in somebody else's business, like the stock market, or, they could even get into real estate, on the side. But the money was made on the side. It wasn't made with their JOB. So over here in a business, the upside potential is huge. Does that make sense? The upside potential here is outrageous. And we want to work with that. Now, when you're talking to a client, you need to bring this to the foreground as far as, that these expenses are only for this group. Now, if someone has a JOB and they take me out to lunch, can they write it off? Someone has a JOB and they have a party at their house, can they write it off? Over here in a business, if I have a business and I take somebody out to lunch and talk about my business, can I write it off? If I'm over here and I have a party at my house, can I write it off over there? So you can see the haves and the have-nots. The haves have a box called expenses. The job people are always going to lose. And it's everywhere the Communist Manifesto is gone. Second plank of the Communist Manifesto, income tax. They always have the ability for business people to write off their stuff. It's not nuclear science. It's everywhere. So I had clients when I used to teach at Palmer and Life Chiropractic colleges, and they would say, oh my gosh, I'm going to Canada. Yes, communism's up there. You'll have this box called expenses. Oh, I'm going to be practicing in England. Not a problem. The communists over there have this box called expenses. It's not nuclear science. Now, I'm not going to do the taxes for them. It's hard enough learning, the taxes for California or Illinois or whatever. But I tell them, hey, find somebody that really understands how to make that box sing. Then you will do well at your business. Now, how many people in business do you think maximize that box called expenses? What percentage do you think? Almost none. No one's teaching this. The average CPA enrolled agent is so busy sitting at the computer night after night, programming the computer with all the data that he's gathered during the day, he doesn't have time to teach this. So what we did with Don Fletcher, myself, and a few other people, is we said, the game looks like this. Here you come up to tax season. Okay, you're up in tax season. You're in let's say you're up in March 15th. You come in with all your books from your business and you sit down. What is the probability that I'm going to have time to work with you and teach you how to win? There's no time. I'm sitting there, I am so burnt out 7 days a week doing the tax prep. I don't have time for that. How many CPAs or old agents do you think in the middle of the year, let's say, July, August, September, October, November, when the pressure's not as on as much, how many of them think, hey, let's have a big class and let's learn how to get into a business and write it off? Nobody. They're all, they go, hey, listen, I get a break, I'm going to take my break. You see what I'm saying? So what we did is with Don Fletcher and myself, we created that middle category. So you have the preparation here. Okay? So the preparation during tax season gets done, but the strategy how do you spell strategy? G-Y. Strategy. Anyway, the strategy never gets done. So where I bring value to the marketplace is not in the preparation, but is in the strategy. I sit down with them and I say, listen, let's go through the 250 to 300 areas of deductions. Let's set up your QuickBooks. Let's do what it takes to make that work for you. Does that make sense? It's never going to get done by the enrolled agent and the CPA or whoever's doing the taxes. And then you got the worst case scenario is where somebody goes to TurboTax or one of those fraudulent programs and they think that they're getting wisdom. Well, they don't even know what question to ask. I just heard on the news, TurboTax is saying, oh, we have people that you can ask your question. I'm not even smart enough to ask the question. You see what I'm saying? Somebody's got to teach you, well, hey, if you do this, then that. Well, everything in taxes is based on this one word, intent. What was your intent when you spent the money? Okay? So, a lot of accountants go, well, I'm not going to take that deduction. That's way out there. Well, it may be way out there, but the intent is there, then the deduction follows. So you have to ask the client, like if you're doing tax prep, what was your intent when you drove the car? You're telling me you drove 100% for business. 100%? The IRS is not going to accept 100%. They're going to say, surely you brought Chinese food home once in a while. See what I'm saying? So was your intent 90%? 80%? No one ever asks them that question. The average CPA or enrolled agent says, how many miles do you drive for business and how many miles do you drive total? Does this guy smart enough to know which one was business and which one was personal? Probably not, right? Unless it's a dump truck that he never takes to church, never takes to, go out to dinner. Does that make sense? Unless it's a dump truck, he's making up a number. Okay? So the question is, we want to teach them how every time they spend that money, it's a deduction. That mileage goes with it. And like when we get to the lexicon, we're actually going to go through each of these deductions and show you, how to create that in the person's mind. Now, the reason people fail is that there's a spectrum of people doing taxes out there. There's a spectrum. There is people that are CPAs or enrolled agents or whatever, and the average personality, because there's 4 basic personality types, and you really need to know this stuff, and there's all kinds of ways to find this out, but there's 4 basic personality types that you're going to encounter. You're going to encounter a driver. They always want the bottom line. You're going to go and find people that are expressives. You're going to find people that are amiables. And you're going to find analyticals. Okay. Now those 4 quadrants get broken down into 4 each, so there's 16 total. Okay, when you're dealing with people and you're trying to get value, what is the value you want? What is it that you want in terms of value? You're with a client, potential client. What do you want from him? Exactly. You want money, right? Because you're bringing a service, a valuable service to the person. What do they want? They want to learn. I have never met somebody who says, oh no, I'm happy, spending all this money on the second plank of the Communist Manifesto. No, I don't want to learn. So they want the wisdom that you can impart to them, and we would like to get paid for it. Okay? It's an exchange of value. Okay, so here are your 4 basic personality types. And usually this starts, like when I went to Mutual in New York and sold insurance, when I was at Mutual in New York, they forced us to take this test. And what you did was you took 5 of your friends from different venues, meaning not everybody was on the baseball team or in the Boy Scouts or whatever. You took 5 people that knew you in different lights, and they said, "What is Tanner like?" And they had a questionnaire of 100, like 100 questions. and then they would send that into a central source, and we would come back with your personality type. Okay, this is going to be important to understand why CPAs fail. So when mine came back, this is cut down into another 4. I was right there. I was an expressive. I like talking, right, Aaron? I like talking, but I'm also a driver. I want to get that job done. Because the sooner I get it done, what can I do? I can go do something else, can't I? My dad was more of a driver analytical. Okay? Now, a driver is someone who wants the bottom line. An expressive just wants to, oh, hey, have you heard this story or do you hear that? An amiable says, oh, why don't we'll go wherever you want to go. They just always acquiesce to whatever anybody else wants. And an analytical is someone who wants all the data. When I was selling life insurance, the worst of the worst person that I had to deal with was an analytical. And you know why? Because when I showed him the charts, here's year 1, 2, 3, 4, 5, 6, 7, 8, 9 to the rest of their life, right? And here was all the money that when it would accumulate. They go, I don't understand what happened between line 15 and line 16 on year 10. I mean, it's all actuarial studies, right? I mean, it wasn't something I go, you know what, I'm going to fill you with so much data, and you have at it, and I'll come back whenever you're ready. Because I wasn't going to sit there and pick apart why the actuarial tables were what they were. It didn't mean anything to me. Now, the driver was just someone who wanted the bottom line. Hey, how are you going to help me? Great. We're going to put more money in your pocket because of this. Expressive. Well, tell me the story of how you learned all this stuff. The amiable. Oh, yeah, I think we'd like to do that. Now, they all have their own problems, and we might do a whole lecture just on those 4 types. Now, the average CPA enrolled agent, out of those 4 types, and you haven't really done a lot of studying on the 4, but out of those 4 types, which one do you think usually becomes an accountant?
Analytical.
Analytical, because they what? They deal in numbers. Crunch, 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 crunch. Oh, they're in 7th heaven. Do they teach? No, they're not going to teach. Do they lead? No. In the military, they took analyticals and they put them in charge of the supply. Because, 15 beans go to this place and 13 beans go to that place. They're in 7th heaven. But they're not going to lead. They're not going to lead the battle. Amials don't do very well either. By the way, these are introverts. Those are extroverts. Does that make sense? Okay, so you don't usually find CPAs being extroverts. So when I come along, or Don Fletcher was probably in a very similar position, we want to tell the story and we want to get the thing done. Do you have a question, Tanner? Okay, so I think what we should do is pay for, have e-tax options pay for the personality of each of you guys. You, Caleb, Tanner, and the 3 of you, and figure out where you are, because where you are is how you deal with the other groups. Does that make sense? So when I was selling life insurance, I would go into a house, I'd walk in and I'd pick something they had that was nice. I go, that's a very beautiful picture. And I'd walk in, that's a very beautiful picture. And the guy would go, yes, I was in Maui on such and such a date, and that cost me $8,221.59. I'm going, oh crap, I'm going to deal with analytical today. You see what I'm saying? And amiable. Well, I'm really glad you appreciate it. I really think that painting looks really nice. Because they're amiable. A driver. Did you come here to look at my paintings, or are you going to teach me about taxes? Not a problem. You see what I'm saying? An expressive. My gosh, oh yes, don't you just like the way the colors? And you can find out right away who these people are. You got the picture? So you have to know who you're dealing with and what is of value to them. Does that make sense?
Yeah.
Once you figure out what's of value to them, then you can feed them exactly what they need. Now, like I said, for me, the hardest is the analytical. I don't want to deal with line 15 and 16 between year 20 and 21. It wasn't worth my time. Now, the other three groups I got along with pretty well. But even these guys, just feed them all the data and they'll buy. Okay, so out of those four groups, which we haven't done a really good job of explaining completely what those four groups are, out of those four groups, which one do you think probably 90% of the CPAs and their old agents are?
Analyticals.
What do you think, Tanner?
I think analytical, maybe the bottom left.
The expressive?
Yeah.
Oh, the amiable.
Amiable.
You get so much crud as a person who does the taxes that these guys wouldn't last long, you know, in a position where there's a lot of stress. Does that make sense? I mean, like right now, I've got one client, he's all over me because the state of Illinois has got a lien against his property. Well, we've already solved the problem like 3 months ago, and they just sent another lien letter. Well, it was solved 3 months ago. And so the guy's, in your face. You know what I mean? These people usually can't handle, and it's not the accountant's fault, it's the state of Illinois' fault. You see the concept? You know, so you're getting crud for something you didn't even do. So anyway, analyticals, most CPAs or old agents, accountants are analyticals. Now, are they going to lead you to the answer? No, they're not going to lead you at all. So what they do is you have legal deductions, and the average CPA only takes you about halfway down your legal deductions. Now, if you're a paid professional, like if you're a chiropractor and you get paid to be a chiropractor, don't you think you should be doing the best job you possibly can as a chiropractor? Wouldn't that make sense?
Yeah.
Why would accountants and CPAs and old agents that are analyticals only take you down your half your legal deductions? Like when they see something missing, they don't go, oh, you're missing this. Why would they do that?
Why? I don't know.
Yeah. What?
Risk.
Where's the risk?
Well, if you
You're
don't
on the
take-
right track, but what's the risk?
If you don't take any risk, there is no risk.
Right, well, as a matter of fact, if you end up going to an audit, which has a possibility, right? If you go to an audit and you haven't taken all the legitimate deductions and you want to get out of there as fast as possible, you fold and say, oh, before we start, Mr. Auditor, I want to let you know that my client forgot to take this, and this. Here's all the documentation for those four things. So I had many clients in the beginning where the auditor, where the client came to me and says, you know, my accountant is the best thing since sliced bread. I said, oh yeah, that's really interesting. How do you come by that thought process? He says, well, we went into an audit and my accountant got us back $4,000. That's how good he is. You see the concept? I said, you're kidding me, right? You think he got you $4,000 back? Were those your legitimate deductions? Does the IRS just give away money? No, money was yours way back on March 15th when you did the tax return. You had legitimate deductions. He didn't even tell you what they were.
The IRS got you that money back.
Yeah, well, the IRS did because, when the audit comes, now the auditor goes, oh, I forgot to take this. So it's a complete reversal. The analyticals got the people mesmerized by the fact they got money back in an audit. They never got a nickel back. They just forgot to take it. I go, so how many years have you been letting him do this to you? The guy goes, man, this guy's been ripping me off. So I take this guy from hero to zero in 30 seconds. Is that clever? Guess who he wants to have do his taxes from now on? You see the concept? Okay, so there are things called illegal deductions. That's fraud. And we don't want to go there, right? We don't want to tell the guy to lie or, like, in the case of the truck, take 100% of his truck when the IRS is not going to give him 100%. But then you have this massive gray area. Okay, and what I do with clients, based on the 250 to 300 areas of deductions, I take them all the way down the rabbit hole and teach them all the deductions of things they can legitimately write off based on the law. Does that make sense? Stuff that IBM teaches, their IBM lawyers teach, their IBM people, Lockheed, Rohr, Convert, General Dynamics, you name the company, the attorneys teach their sales force, teach their, their people how to write everything off. Who helps the little guy? No one. Not the public fool system, not, definitely not the accountant and enrolled agent, So what we do is go through the 250 to 300 areas of deductions based on the lexicon, which is just Greek for list. So list of business expenses. And I tell the client, because it's based on my intent, no, their intent. I go, I have no clue as to these legitimate deductions if you in your heart of hearts believe that they're legitimate. Does that make sense? Now, you may not have the intent for the year, let's say 2018, but now that we're in the brand new year of 2019, let's start creating the intent on all these deductions. Now, when we talk about intent, are there many intents? There's many intents, aren't there? Would you agree? When I go out to dinner, when I was married, my intent was to stay out of the doghouse. Does that make sense? Okay, my intent was to go have a good meal. Why? Why have a bad meal? My intent was to talk to somebody about e-tax options, personal care, QuickBooks, some aspect of the business. Now, when it comes to the taxes, which one of those three intents am I going to share with the IRS? Business. It's your business. Does that make sense? So the bottom line is, I tell my clients, I don't care. You only want to go that far, that far, that far. You only want to go that far. Great, it's a starting point. You can go down as far down the rabbit hole as you want, and I'll back you up based on law. If you don't feel comfortable creating the intent, don't take that deduction. Now, what does that do for me? It takes me off the hook, doesn't it? Because if we ever get audited, my gosh, was this not your intent? When you put that number on the piece of paper, was that not your intent? Okay? So anyway, the bottom line is, we don't go into the illegal, but we do maximize the gray area. So, I think that's good enough for a first lesson. By the time we get the second lesson, hopefully I'll have my cold gone.